Right now, millions of young people in India are shifting their money out of the tangible assets their parents loved and pouring it straight into digital financial platforms. For decades, the older generation locked their savings away in physical real estate, low-yield fixed deposits, and heavy stacks of gold. They wanted investments they could touch, mostly because they were terrified of the stock market. That fear wasn't unearned. The highly publicized market crashes and massive financial scams of the early 90s wiped out countless portfolios and left a lasting scar on an entire generation of investors. Today's digitally native generation has surplus income and no living memory of those historical crashes. They log into apps looking for rapid financial growth and massive returns. But without the institutional knowledge of how markets actually work, millions of new investors are treating the stock market exactly like the unpredictable casino their parents warned them about. Instead of building lasting wealth, they are systematically wiping out their own capital by falling into three highly predictable behavioral traps. The first trap is the illusion of daily trading. Investors jump in looking for quick cash, often paying thousands of rupees for bogus advisory tips and magical stock picks that promise massive daily returns. What these extensive advisors don't mention is that daily trading is a zero-sum environment. Every time you buy, someone else is selling. Without deep analytical tools and years of fine-tuning, a retail trader is mathematically guaranteed to land on the losing side of that equation. When active trading fails, investors pivot to the second trap, trying to replicate the exact portfolios of famous billionaires, assuming they can ride their coattails. The fatal flaw here is information delay. Public filings will gladly tell you what a star investor holds in their portfolio, but they keep the exact time and price of their initial purchase strictly private. If you buy a stock simply because a billionaire owns it, you are likely buying it years after they did. You end up absorbing all the exit risk right at the peak of the market, precisely when smart money gets ready to sell. Copying a billionaire's picks without knowing their entry price means you are effectively volunteering to hold their expensive bags when they decide to cash out. The third trap triggers the moment the broader market takes a dive. When share prices plummet, retail investors rush in to buy individual stocks. They see a red ticker and equate it to a clearance sale at a shopping mall, assuming any cheap stock is bound to bounce back. But the stock market does not operate like a mall. Without a dedicated research team analyzing balance sheets, these buyers end up catching falling knives, pouring their savings into failing companies that are heading straight for bankruptcy and will never recover. Unchecked human psychology turns standard market corrections into permanent capital destruction. Over time, the data proves definitively that trying to pick individual winning stocks is a losing game for the average person. If we look at the data over a 10 to 20-year horizon, a staggering 90% of elite, full-time professional fund managers fail to beat the performance of the broader market index. If professionals with infinite analytical resources and insider access cannot outsmart the index, a retail investor doing this as a hobby between meetings has a statistical 0% chance of pulling it off. The only mathematically proven solution for retail wealth is also the most boring: setting up a systematic investment plan, or SIP, and dripping your money continuously into a broad market index. This chart shows Indian equities over 30 years. Despite crashes, the index delivered a 14 to 15% return, mathematically outperforming real estate. You can tailor this by combining large, mid, and small-cap ETFs, completely removing the need to pick individual stocks. True wealth generation requires admitting you don't have a secret edge in the market. Direct your active energy into your actual career, where you do have an advantage. Park your capital passively in the index, and use the resulting wealth to enjoy your life.